Hello everyone, my name is Atul. Welcome to my channel. First of all, a big thank you to each and everyone who has watched the video or who has subscribed to my channel or who has commented on the video. Each and every comment is welcomed, and thanks for liking the training sessions. So if you're new to the channel, then please subscribe to my channel and please hit the bell icon. Also, in this video, in this particular session, we'll be dealing with what are the types of guarantees which are used more frequently in international markets. Also, please share the videos to maximum to as much people as you can, so that everyone can be benefited out of these. So without wasting any time, let's get started. We'll be taking one example, and through that example I'll be trying to explain you around 6 to 7 types of guarantees, that how step by step many guarantees gets triggered one after the other just by one project. We have a construction company A. We have a road construction project. The total cost of project is approximately $100 million. B is the government entity. Now government entity says that whomsoever wants to bid for this project have to give me a guarantee. That guarantee will be that in case if you win that project, then you will not back out once we have disclosed that you have won the project, and you will do the further formalities, further paperwork, and you will start performing as per the contract relevant to that project. Okay, so A wants to bid for this construction project. So what A will do, A will go to his bank. Bank will issue a guarantee to B. B is the relevant government entity who has invited for these bids. So B would be the beneficiary of the guarantee. A will be the applicant. Now this particular BG will be called as a bid bond guarantee or a tender guarantee. So tender guarantee is a guarantee which is issued so that the applicant can place its bid for this project. Once a bid is placed, then company B or the beneficiary will be choosing from all the bids which have been received that which entity has placed the lowest bids. Now the condition will be whomsoever wants to bid for this project, be it A, be it C, be it company E, be it company Z, everyone will go to their respective banks, bank 1, bank 2, bank 3, and all the banks will be giving respective guarantees on behalf of their clients who will be bidding for this project. Now typical condition of such kind of guarantees is this guarantee will be effective if the applicant wins the bid. Next, if A wins the bid, if the relevant paperwork or relevant activities or relevant performance has not been initiated by A as per the contract, then this guarantee will be encashed. So such kind of a guarantee which is issued to enable an entity to participate in a bid is called a bid bond guarantee. Usually a bid bond guarantee is issued for X% of the total contract price. So beneficiary might fix the amount that if you want to bid for this project, you have to give me a guarantee for 10% of the project value. So all the entities would be giving their share of 10%. That is, A would be giving a guarantee of $10 million. C, E, Z would be individually giving a guarantee of $10 million to the beneficiary. So this is a bid bond guarantee. Now bid bond guarantee is issued and A won the bid. The moment A won the bid, A has done all the paperwork which was required as per the contract. Now A says, I do not have this much capital with me. I request you to give me some amount of money in advance. So what B does, B will pay advance to A. That advance would be again some X percentage of the total contract price, say 30%. So B pays A $30 million. This is paid to A as advance. Now B says, I'm paying you $30 million as advance. You give me a guarantee that you will perform work worth of 30 million in a stipulated period of time. How that time will be decided? Suppose this road construction project is total for 5 years. Okay, so B will say, I have paid you 30% of the amount. You give me a guarantee which is valid for 30% of the total contract, total time period allocated for this project. So A will go to the bank will issue a BG to the beneficiary, wherein that BG will be for $30 million. The time period of that BG will be 1.5 years, and BG will be covering the obligations of A for this much time period, for this much amount towards construction of road. So a guarantee which is issued in lieu of the advance which is paid by the beneficiary to the applicant upfront before even applicant starting to work for the project is called as a advance payment bank guarantee. Advance payment bank guarantee will be typically having an effective clause which says, for example, this guarantee will be effective from the date of receipt of advance in A's account. Why that condition is there? Because this advance is required by A to start the construction work. It should not happen that B is claiming from the bank for this amount which has not at all been paid to A. So unless and until B pays this money to A's account, B will not be having the right to claim under the guarantee, because unless and until A has this amount, A will not be able to start performing or start making the road. So B will pay advance, A will give a bank guarantee to B to the tune of this advance for considerable or proportionate time period. This kind of a guarantee is called as an advance payment bank guarantee. Now A says, okay, remaining part of the contract I can do it on my own. Beneficiary says, I don't trust you, boss. You give me a bank guarantee that that ensures that you will perform as per the contract for the remaining part or for the remaining obligations which are still pending. So B will say that 30% is paid as advance. Now 70% is left. You give me a bank guarantee covering 70% of the total contract value, because boss, I don't trust whether you will be able to perform as per the contract or not. So A will go to the bank and bank will issue a BG for $70 million. The time period will be 3.5 years. This BG will be given to B. This BG will be covering $70 million worth of work which will be completed in 3.5 years. So a guarantee which is given to ensure performance as per the contract is called as a performance guarantee. So we have seen bid bond, advance payment, performance BG. Okay. Now usually what happens is, when a contract is of a very huge value, since the contract value is very high, some part of the amount government wants to keep it themselves. Why? Because suppose a road is made. Now this road construction project is for $100 million for making 500 kilometers of road. Alright, now when applicant has made the road 500 kilometers, government should have some time period to check whether the quality of road is okay or not as per the contract. For that some time is required. Now I'll pause over here. I'll take a different example. Suppose we are doing whitewashing in our houses. Okay, so whenever the painter comes, we have done a deal that for my house you'll be taking say $1,000 to whitewash the entire house. Every time we do not pay the entire $1,000 in one shot. We will be keeping some amount with us. Say we have paid $600, $400 we have kept with us. That $400, since it is kept with us, that will ensure that the person who is working or the person who is whitewashing the house or painting the house will work as per what we have agreed. And then after seeing that the entire work is done perfectly, then you will release the balance payment of $400. Okay, so this is a very basic example which I have taken, that usually these kind of things we do not pay the entire amount upfront, we keep some amount with us so as to ensure that the performance is done or the activity takes place as what was earlier or initially agreed. Similarly happens in trade business. This road construction project is of $100 million for construction of 500 kilometers of road. Beneficiary says, what is the guarantee that whatever road you have built is as per the contractual obligation or not? So to ensure this, what beneficiary does, beneficiary will keep X% as retention money. Retention money means A has performed as per the contract, beneficiary will pay A $100 million minus X%. Beneficiary keeps $10 million as retention money. This means beneficiary will only pay A $90 million. Balance 10 million beneficiary will keep with itself. That 10 million will be released after some time period. Now why that time period is there, beneficiary will say, this amount I am retaining with myself so that once I have checked that whether the work is as per the contract or not and I am satisfied, after that I will release this 10 million. Applicant says, boss, I have done work worth of 100 million. I have payments to be made to the workers or laborers who day and night worked to ensure that this 500 kilometer of road is made in the stipulated time period. I do not have capital to pay to those people. So what you do is, you pay me this retention money. Okay. If in case you find some defect in my work, I will pay you back this 10 million. But you pay me this 10 million upfront. Beneficiary says, okay, I will pay you this $10 million upfront. 90 million is already paid. This 10 million which beneficiary was keeping with itself, beneficiary is paying this 10 million to the applicant. In return, applicant is giving a retention money BG to the beneficiary. This BG will be saying that if in case the performance is not as per the contractual obligations to the tune of not as per contractual obligations as what is agreed, this retention money will be called back. This is a retention money bank guarantee. Okay. Next comes warranty guarantee. Now warranty guarantee and retention money are more or less of the same nature, wherein in both the guarantees the quality of work is basically the underlying, but in case of retention money the amount claimed would be a fraction of the total contract value, whereas in case of warranty it will be the total contract value. So I'll pause over here. We'll take an example. Suppose we have purchased a mobile phone. Okay, with that mobile phone we get a warranty. That warranty is that your mobile phone will work as per the terms and conditions listed in the warranty document, and if in case your phone develops some problems some problems which are covered in the warranty document, then your entire phone will be replaced, or you might get a payment back to the tune of your entire mobile. So in this case the entire mobile set is being replaced, or you are getting a refund of whatever payment you did to purchase that mobile phone. There can be n number of other conditions, but basically warranty usually covers the entire product or that entire part. So now beneficiary says you did the work, everything is fine, $100 million I paid you, 500 kilometers of road was made well within 5 years. Now applicant says although this construction has been done in 5 years, this road will last for 15 years. Okay, so in this case beneficiary will say, boss, you give me a warranty guarantee that this road will be valid or will be in working condition for 15 years, and in case this road develops some defects, then you will be doing the repair work free of cost. So applicant will give a guarantee to the bank, to the beneficiary towards warranty. I did the work. Now this is a guarantee which ensures that if the performance done by me is not as per the quality which was agreed in the contract, then I will do the repair work free of cost. Beneficiary says if in case this repair work is not done free of cost, beneficiary will encash this BG and claim the amount. So through the same structure we saw tender or bid bond, advance payment, performance BG, retention money, warranty guarantee. Okay, now there are two more types of guarantees: subcontract 1 and subcontract 2. Now subcontract 1 is similar to payment guarantee. That payment guarantee we have not yet seen, so we will see it afterwards. Subcontract 2 is similar to performance guarantee. So in this particular case, A got the bid and A was doing the work to make the road. Suppose A has delegated that work to another company C. A sold a part of the contract to another company C, and that company C is doing the work of constructing the road. So in this case, A comes in beneficiary's place and C comes in A's place. How? Earlier A was working for B to construct the road. A was supposed to perform. That performance obligation A has transferred to C. So now C has to perform the work, the construction work, and since A has given that contract, so A will get a guarantee from C through its bank. This we will label it as bank 1. C will go to the bank. Bank 1 will give a BG to A. This BG will be covering the performance of C as per the subcontract taken place between A and C. Why this is a subcontract? Because this contract which happened between A and C is derived from this main contract. So A has sold part of his share of obligation to C under a subcontract taken place between A and C, and A has called for a guarantee from C to ensure that C performs this activity as per the subcontract. So such kind of guarantee is called subcontract 2 guarantee. Okay, this subcontract 2, that numeric 2 might not be there, but this is what is called as a subcontract guarantee, wherein a guarantee which is issued for a contract derived from a parent contract is called as a subcontract guarantee. Now, okay, let's look at one more type of guarantee, which is payment guarantee. Now, as the name suggests, payment guarantee covers the obligation of making payment. So once A has done the work as per the contractual obligations, A will raise invoices on beneficiary, and beneficiary is supposed to pay. A says, boss, I will be doing this construction work, this road will be made within a time span of 5 years. What is the guarantee? That you will release the payment to me immediately. So A says, you give me a bank guarantee, which is a payment guarantee, that if you don't pay me as per the contract, as per what is agreed in the contract, I will go to the bank and claim this payment. So in this payment guarantee, beneficiary will request the bank, and bank will give a BG to the entity who has constructed the road. So this BG is payment guarantee. Payment guarantee is a guarantee which ensures that the payment is made by the paying entity as per the contractual terms and conditions once invoices are raised. So similarly, if a payment guarantee, now in this scenario, A and B had the main contract between them. Let's move the same structure to this, C and A. C is constructing this project for A. Similarly, C will say, I will do this work. What is the guarantee? That once this work is done, once I raise the invoices on you, you will make payment. So now you give me a guarantee covering your payment towards me. So in this case, A will go to the bank and bank will issue a BG to C. This BG is covering the payment obligation that A has to perform for the work done by C. Since this bank guarantee is covering a payment obligation under a subcontract, it is called as a subcontract payment guarantee. So same example we have seen 1, 2, 3, 4, 5, 6, 7, 8 kind of guarantees. Whenever a project happens, guarantees will be issued in same order. Some steps might be skipped, but if a tender happens, there is a very high probability that there will be an advance payment bank guarantee. Once an advance payment bank guarantee is issued, there will be a performance guarantee, then retention, then warranty, and then payment. Okay, now let's look at other types of BGs. Another type of bank guarantee is customs guarantee. Suppose A has exported some goods to B, which is television sets. Some of the television sets develops some defect. Now, since these TVs have developed some defect and these TVs are under warranty, A will import these television sets, rework on them. Whatever the problem is, that problem will be rectified, and then these television sets will be re-exported. So once A imports these television sets, this import will call for custom duty, because anything what you're importing in your country will attract customs duty. Now A goes to the customs department, tells them that I am not importing these TVs for my own consumption. I am just importing them to work on them and re-export. Now when these TVs will be re-exported, my obligation towards B will be completed. So please do not consider this as a regular import and waive my customs duty. So customs department will say that okay, what is the time period that you within which you will do a rework and re-export? A says 1 month. So customs department will say okay, you give us a guarantee valid for 1 month and which is for the amount equal to the customs duty applicable on this import. So suppose the customs duty applicable on this import is $10,000. So A will give guarantee of $10,000 valid for 1 month to customs department through the bank. A will go to the bank. Bank will issue BG to customs department with this specification. So when a guarantee is being issued in lieu of customs duty applicable on the goods which are being imported for the purpose of re-export within a stipulated period of time is called as a customs guarantee. Okay, this definition which we are seeing, this is as per the definitions given in CSDG syllabus. All right, let's move on to the next type. Next type of the guarantee is court guarantee or arbitration guarantee. So court guarantee is basically if two entities got into a dispute and court gave an order that A has to pay B some certain sum of money. So what court will do, court will say A has to pay B $1 million because of some underlying dispute and because this verdict has been given by the court of law. So court will say till that time this $1 million is paid to B, you deposit a bank guarantee with us favoring B, so that if in a span of 1 month or 2 months, whatever is agreed between these parties, if between that stipulated period of time A doesn't repay that money to B which is due to B under a court order, then that guarantee will be encashed by B and he will get the payment. So any bank guarantee which covers the amount due by virtue of a court order is called as a court guarantee or an arbitration guarantee. Okay, Next type of guarantee is a parent company BG. Now A was supposed to ship some goods, and under that contract B asked for a bank guarantee. So A being the applicant, B is the beneficiary. Bank has given guarantee to B. Now parent company guarantee will be A is subsidiary of C, C being the parent company. So C will give a guarantee to the bank, ensuring that if there is a claim from B, that claim will be paid by the bank, and bank will come for reimbursement. To A. In case A doesn't pay, then I will pay. So 1, first this will happen. 2, bank will pay. 3, bank will ask for reimbursement. If A doesn't pay, then C is giving a guarantee to the bank covering payment obligation of A towards the bank. So such kind of payment obligation, such kind of a guarantee which is covering payment obligation of a subsidiary, and a guarantee is being given by a parent company, is called as a parent company BG. Next comes financial BG. Financial BG, as the name suggests, the underlying is just deposit money, or the underlying is just to deposit money in some account or for some obligation, will be termed as a financial BG. So for example, suppose we move into a rented flat. Now when we move into a rented flat, we have to give some deposit. For example, maybe 1.5 months or 2 months, that deposit is to be kept with the landlord. What that deposit is for, that once you vacate the premise, if there is any damage caused by you in that area, the landlord will deduct money from that deposit and then will give you the net amount. So in that case, the underlying which you have to perform is deposit some sum of money. If you are not depositing that sum of money and you are giving a bank guarantee instead, will be termed as a financial BG. So the example which I took was just to explain, but financial BG is when this deposit is to be kept with some banking company or some insurance company. So a financial BG will be covering an obligation wherein some depositing of some certain sum of money is covered by a guarantee. Okay, so with this, friends, we have completed what all are the types of guarantees which are there in your CSDG syllabus. If you have any questions towards the classification or any clarifications needed, please post your queries in the comment section. Also, please do like the content if you are satisfied with the explanation. Have a great day. Thank you.